Okay, folks, welcome to the Contrarian Trader. This is Bob Desmond, and we're going to go over the members stock pick request video. This is where our members submit symbols that they want me to review on video. It's part of their service. It's very popular, and I'm pretty much the only one out there that does it. But before I get to the before I get to the charts of the stocks that were submitted, I want to go over where we're at in this market, where I think that this market is heading, so you get a good feel for what my thought process is or what my sentiment is as I go through these charts. Now, today, you had the Federal Reserve with their Fed rate decision, and of course, there was no interest rate hike. The bond market and the stock market, as well as the FX markets, took it as a hawkish statement. I don't think that they were listening to the same report I did. What I heard today on that report released from the Federal Reserve is that we are now the central bank of the world and that we are going to remain accommodative until kingdom come. Now, how do I know that we are not going to be raising interest rates anytime soon? All you need to do is take a look at the durable goods orders that were released yesterday and the revised numbers from November. When did we end QE? October of 2014. In November of 2014, the following month, we had durable goods. And for those people that aren't familiar with what durable goods are, those are products that we purchase that last several years. Automobiles, washers, dryers, etc. Big ticket items that last. What was the durable good number for November? Negative 2.1%. They expected a beat. What was the durable goods number for December of 2014? Negative 3.4%. There is no way that the Federal Reserve is going to raise interest rates when you have durable goods not just falling, plunging. Let's get to the charts. Dow Jones Industrial Average 100-year view. Again, this is just to get a feel for my sentiment. You go back my past posts, I've gone over this chart before. I've been warning about the sell-off we're about to see for a long time now. And we had a great day today. The markets took it on the chin. It was our best day of 2015 because we are short of the market and we added to our short positions. And we will continue to add to our short positions. Now, this is the Dow Jones Industrial Average quarterly chart, 100-year view. This is our long-term uptrend. This upper band here is the upper band of the rising uptrend channel. We hit it the first time back in 2000, then again in 2007. What do those two instances have in common? We saw massive corrections immediately following. Here's where we're at now. We hit this upper band in 2014. Now let's drill down to see where we're residing since we hit that upper band. Now here you have it, same chart, 2000, 2007, current. Last quarter, we pierced and closed above the upper band. And I warned, I sent out alerts starting in Q3 of 2014 that we were looking to get short the market. And we shorted into that September-October sell-off and we made a great profit. The stock market rallied back. We closed above this upper band. We began shorting once again. And we added to our shorts again today. And members, stay tuned for the market wrap. I'll be getting to that right after this video. And we'll go over the game plan for the coming days. So getting back to this chart here, we opened up the first quarter of 2015 above. Now we are breaking down below. We are down on the year on the Dow Jones Industrial Average. And I expect this chart to get a lot uglier very, very quickly. Facebook. They reported earnings after hours. They disappointed for some reason or other. I can't believe this, and I've been warning about it for months now. The U.S. dollar, which is great to see our currency rallying, was going to have an adverse impact on our multinational companies. A strong U.S. dollar makes the currency conversion from foreign currencies back into the U.S. dollars more expensive for companies. It also makes our products more expensive overseas. So it's not good for sales moving forward. Now, I always like to tell my members that the markets send you signals. And the market sent you a signal back here that Facebook was weak and getting weaker. We had hit a peak on RSI in July of 2014. We pulled back. We rallied on to new highs in October of 2014. There's only one problem. The RSI was in a downtrend. That's a divergence. Then fast forward to this breakout in December, and we failed to hold that breakout point, and we rolled over. This is a breakout point failure, a very, very bearish event. And I always tell my members, whenever you see a breakout point failure, again, meaning we broke out above this upper band, couldn't hold it, and rolled back over into its trading range. In all probability, you are going to retest the lower band of that trading range, and there is a very high probability that you will break down below that prior support level. This is what we're seeing now. And now Facebook reported after hours, disappointing, they're down. The after hours price is very, very volatile. It was down $1. Last I looked, it was down 58 cents. Lord knows where it's going to end up, but I expect that we're probably going to break down below this key support level sometime in the near future, because I frankly think that this market is heading lower. Apple. This is the first member stock pick request, and the reason why this is the most important chart I'm going to go over today is because Apple is, for the most part, supporting earnings for the entire S&P 500. Earnings this season are disappointing. Revenues, horrible. So Apple was in a trading range for several weeks, very, very healthy consolidation within a triangle formation. What happened? It broke down. Now, going to this earnings report, everybody knew that Apple was going to have blowout numbers in China. And sure enough, they hit it out of the ballpark. 100% growth in China this past quarter. So if that was a known, why did the stock break down below this triangle formation? To me, this is the market sending you a signal. So we gapped higher today on strong earnings. And then when you take a look at the intraday chart, we gapped higher, pulled back, no problem there, pause it, refreshes, rallied, put in a higher low intraday. This stock should have continued higher through the highs of the morning and into the afternoon. What did it do? Put in a lower high. And what only made matters worse is that it broke down below the morning lows and closed at the lows of the day. Very, very bearish price action, despite the fact we closed up on the day. I think that we're probably going lower on Apple. And if there's any company out there that should be trading higher, it's Apple. This tells me that the market is sick. There is something structurally wrong with the market. You have the transports, which are breaking down. The Baltic Dry Sea Index. For those who are not familiar with the Baltic Dry Sea Index, here is a chart, weekly chart. The BDI is an index that tracks the pricing power of dry bulk shippers. It's an indicator or an index of global growth, because if there's strong global growth, well, then dry bulk shippers should be able to charge more to carry that freight over the Atlantic and from the Pacific. But they can't. In fact, we closed down lower again today, and we are testing the lows seen back in 2012. This is global growth in one picture, one chart. And this is why I encourage everybody to learn how to read the charts. You can listen to all these talking heads on CNBC, but they are not going to tell you the true story. This is the true story. This is the global economy breaking down. All right, the rest of this video is going to be all about the chart symbols that were submitted. I will leave the rest of my tirade for my members to listen to on Market Wrap. Okay, so American Airlines, avoid it. I don't care if oil prices are going down, avoid it. Why? It's because we broke out above prior resistance, and it failed to hold this breakout point. This is called a breakout point failure. Again, what I always teach my members is that whenever you see this, expect us to come back down to the lower band of its trading range, and in all probability, it's going to break that support level, which it did, and continue lower. I think that at a bare minimum, You're going to test the 50-day moving average, and in all probability, you're coming down here to 48.31 on American Airlines. I wouldn't touch this stock. It's going lower, volume high, institutional distribution. That's not mom and pop selling 100 shares. You do not get ahead of these guys. You avoid them like the plague unless you are shorting. Altair Nanotechnologies, ALTI. This is a daily chart. I don't know much about this company, but I do know about the chart. It's in a trading range. It's testing the lower band of its support level. Volume is anemic. You know, this is one that you really can't even put in the stop loss, because I bet you the spread between the bid and the ask is a mile wide, and they'll just take you out. You really need to monitor this position if you get long of it. And I would say if you close down below $1 or you appear poised to close down below $1, you got to get out. Me personally, I wouldn't buy the stock. I think it's a broken stock. There are two ways to play it. One, buy it here near the lower band of its trading range. Put a mental stop in below $1 per share. Or two, you open up a position on a breakout above and a close above, I would say between 160 and 149. Watch it trade there for 3 consecutive days. That's a 3-day rule. And then open up a position. Or you can do a mixture of both. Buy here. Keep that mental stop in place. Call it half your position. Add the second half on a successful breakout. Other than that, me personally, I wouldn't touch the stock. Too thinly traded. Not enough liquidity for me. I'd be too worried about getting out of the position. All your oscillators are breaking down. I don't see a trade here. I would caution anyone to stay away from it. And it's certainly not a short. AMLH, American Leisure Holdings, another OTC stock. Folks, you really need to avoid these OTC stocks right now. I think that the market is getting ready for a very, very serious breakdown. If the market breaks down, you need to keep in mind that you have huge, huge margin debt out there. And when those margin calls come, people are going to sell their penny stocks. Why? It's because they're not marginable. So they can get dollar for returns back to satisfy their margin calls. There's no money in the bank to satisfy the margin call, so they're going to need to sell what's going to get them the biggest return to satisfy that margin call. What's going to be that biggest return? It's not going to be selling Microsoft. You're only going to free up a percentage of what your holdings are worth. In the case of AMLH or another penny stock, you're going to free up 100% of the value of that position. So me personally, I would say avoid these stocks like the plague, all OTC stocks, because there's a storm of brewing. That being said, if you're dead set, you're going to trade this stock, what would I do? Again, same thing as I would do with ALTI. There's no magic here. I would either A, wait for it to pull back, retest the support level, buy it there, half my position, and then wait for a breakout and a close above this resistance level in blue. Then I would look to finish my buying, and hopefully the stock heads higher. It is certainly not a short, not that you can get the shares, but I would caution against buying this stock. You have, granted, huge volume last week, no follow through this week, possible double top, possible double bottom, all depends upon the way you look at it. You can look at it glass half full, and we're setting up for a double bottom. I don't think so. I think that the stock is going nowhere. So I think that your money could be put to work in other places better. And note the topping action. We're not even at resistance yet, and we're already flashing topping tails, which is a sign of resistance. Apache, APA, we've had our rally here, folks. I think that Apache, at a bare minimum, is going to come back down and retest the lower band of the support level. If the U.S. dollar continues its rally, Apache is going lower, and it's because oil is going lower. My opinion of the sector is that you've had a rally, a counter-trend rally. You're going to see a resumption of the downtrend. I would avoid it. I see this right now as a probable short. Shorting here on a continuation move lower, and then on a break below this lower band of support, adding to my short position. Big distribution today. Again, not mom and pop selling their 100 shares. This is Goldman Sachs, these are hedge funds selling their shares. Double top. Didn't even have the strength to get above 70 on this counter trend move. The path of least resistance is down. Avoid it unless you're going to short it. CYTK, NASDAQ stock. This is another one I'm going to have to say avoid. The reason being is this, is that we're in a trading range. We rallied up to $8.25, flashed the topping tail, pulled back, and we broke down below the support level, which is fine because we rallied back. That's okay. That shows that there are buyers back here. The problem comes in here is when we rallied back and we didn't even have the strength to rally up to the upper band of the trading range. We put in a lower high. That's never, ever good when you want to get long of a stock. So we pulled back after flashing a topping tail, which is a sign of sellers above, and now we put in a down day today. I think that at a bare minimum, we're going to retest the support level, and we could quite very well break. Remember, these stocks that are low-dollar stocks, they are subject to being liquidated by institutions when that margin calls come. And if what I believe is going to happen soon does happen, you're going to see a vast amount of margin call selling, forced liquidation, and the CYTKs of the world and the OTC stocks of the world, they're going first. And I think the purpose of this rally here was to fill the gap, which we did from this break back in April. And if you haven't seen a change in fundamentals since April, you really need to ask yourself the question, why am I buying it? So the story really needs to be solid. And if the stories change and the fundamentals, you have a good rationale for getting long of it, fine. Use the same rule. You buy half here, you buy more on the breakout. Until then, let the stock show you what it could do, not what you could do for the stock. You buying a few hundred shares here or a few thousand shares is not going to propel the stock. In reality, it just becomes a liability sitting on your account statement until it begins to perform. I would just watch and wait. Let it be somebody else's headache. Electronic Arts, a blowout quarter, gapped higher today on earnings. Would I buy it here? No. Will people buy it here and continue the rally higher? Sure, they just may. I wouldn't be a bit surprised. This is not for the amateur investor. If you do not know how to use a trailing stop loss order, then you should not be trading this stock. Because at some point in time, it's going to pull back and it's going to drop back down into this trading range. It has blown out of the upper band of this rising uptrend channel. At some point in time, it's going to revert to its trading channel, and that's a good thing. That'll be your opportunity to buy more or to get long. It's certainly not a short, despite the fact that I believe the market is going to roll over. There are better stocks to short, and I'll be going over some tonight with members. We did see some selling late in the day. We closed off of the highs. That does not mean that we cannot continue higher. But if you're going to trade this stock, you must use a trailing stop loss order. Please. And I wouldn't buy this stock until we got a continuation move higher on Wednesday. Let's check out an intraday chart. See how we're setting up for Wednesday. All right, this is a rounding top. Note all the topping tails at $55 per share. There is support down here. I don't think it's rock solid support. I think that we could see EA give up some of its gains from today. And what could happen here, and this would be a healthy thing, this prior resistance level could now act as support. And if you flash bottoming tails at the support level, that's a sign that the stock has support at that level and it may continue higher. And then it could become a buy. And what are bottoming tails for those people who have never watched my videos before? Right here on the bottom of the candlesticks. Some people call them shadows, wicks, on candlestick charting, whatever you want to call them. I call them bottoming tails or topping tails, whatever floats your boat. EBR, Central Electricas Brasilias. Okay, so it's a South American country. That I'm pretty sure. We've had a massive sell-off here. It's in a triangle formation. It did break out above this downtrend, so it's in a consolidation. Now, if you're dead set, you need to get long tomorrow, you have to scratch that itch, fine. Buyer position, use a stop loss just below $2 per share. If you get a close below that support level, you got to get out. Okay, you got to get out because it can go a lot lower. You saw topping action today. You have resistance right within this trading range here, right in the midsection of this triangle formation. When would I add more? On a successful breakout above this upper band of resistance. 3-day rule. We're breaking down on the slow stochastics. That is not a positive sign. The stochastics, they're a forward-looking indicator. Not 100%. They could get skewed because the stock is in a trading range. It happens. But ideally, you're not seeing a breakdown on the slow stokes. I would caution heavily about adding here. And I would not short it until you got a breakdown below this support level. EXXI, Energy, XXI Limited, never heard of it. NASDAQ stock, avoid it. This isn't, it's not even an inside day. It's more than that. It broke down to a new daily low. A very bearish day. Good consolidation back down here at the $2.35 level. We bottomed, rallied, pulled back, undercut double bottom setup, whatever you want to call it, W formation as some will call it. The key to this stock here is that you need to either buy it on a pullback and a higher low. You do not want to see it break down below $2.30. If it breaks down below that support level, it's a short. What you want to see is a pullback, higher low, and then a breakout. This is your pivot point, $3.68. You get a close above that resistance level, it's a buy all day long. Gilead. This is another one, all too common. Breakout point failure. We broke out on the 22nd of January, continued higher, and this even passed the 3-day rule. Closed 3 consecutive days above its breakout point. What did it do? It rolled over, broke back down into its trading range. It's now retesting support. This is a common theme of this video thus far in that we're seeing a lot of breakout point failures. We understand what happens when breakout point failures occur. You're going to come back down and retest prior support levels, and in all probability, you're going to break down. I think that in all probability, we're going to break down further on Gilead, and then it becomes a short. The only reason why I wouldn't say short it here is for 2 reasons. 1, it didn't break support. 2, volume has been very, very light. This is not institutional distribution. If you see volume like this begin to pick up, like you saw back in December, then it's a short. JetBlue. Okay, we did American Airlines. Now we have JetBlue. What are declining oil prices doing to the airline sector? Not much. They should be helping, right? But it's not. And that's a tell. Now, unless American Airlines and JetBlue were overly hedged on their fuel prices and they're paying more than the market right now, well then this is a tell that you have major airlines which were breaking out, now rolling over and breaking back down into their prior trading ranges. And JetBlue, look at the volume, the institutional distribution. You could short this as a scalp all the way down here to its prior lower band. JetBlue, I could short it and not lose any sleep. And I would certainly not buy it until we got a successful retest of this prior support level. And even then, I'm suspect. Netflix. I'm going to be going over this one with members in greater detail on Market Wrap tonight. Netflix, I wouldn't say open up a short position. However, I do think that it's going lower, at least down to the support level. Volume picked up today to the downside. That's all I'm going to say about Netflix right now. I would not buy the stock until we got down to a support level. And this is our primary support level right here at 438. We did come off of an extreme overbought level. So while I'm not willing to say that we're going to fill the gap on Netflix, I'm not constructive on the stock right now. And again, more later for members on Market Wrap. Salt. I was asked about this from a fellow member today. Salt is Scorpio Bulkers, and for disclosure, I took a loss on this one back in December. I took a tax loss, and thank God I did. We appeared to have had a double bottom setup. We should have broken out and closed above this pivot point at $2.20. When we didn't, this is our tell. Get out. It's probably going to roll back over at a bare minimum retest, prior support, and it failed. Big time failure today. And I'll take you back to the chart of the Baltic Dry Sea Index. What's happening with these dry bulk shippers? What's their pricing power? What is the market telling you? They are breaking down. In all probability, we're going to break down to multi-year lows on the Baltic Dry Sea Index. What does that mean for pricing power for companies like Salt? It's non-existent. In short, folks, the training wheels are coming off of this carriage. And this is not going to be a pretty outcome for the transportation stocks. We were down 21% today alone on Salt. This is why you really need to stick by your stop loss orders and get out. STX, Seagate Technology, they must have disappointed on earnings. You had a gap down. I don't see a trade here. This hollow candlestick implies that there's indecision between bulls and bears, and in all probability, the bears in the end are going to win out. And the market sent you a signal back here with this head and shoulders setup that you needed to get out. And here was your neckline right here at 63.18. When we broke down below there, that was your sign. You had to get out because we pulled back further, retested a prior resistance level. It held, rallied, and you had this hollow candlestick, a sign of indecision. That's a warning flag ahead of earnings. You had another warning flag here with this topping action, which showed that there was sellers here. So you had a counter trend move after the series of lower highs, and this should have told you, got to get out. We're probably heading lower. Earnings are coming. No reason to get involved here. No reason to hold the stock into earnings and hope when you should fear. And had you heeded the signals that the market sent you and not listened to the thugs on the financial news media, you would have been spared this big sell-off. Don't go listening to these guys saying that Seagate Technologies on a forward-looking basis or whatever their story is a buy right now. It's not. These guys are well-dressed salesmen, and that's it. Don't buy into their sales talk. They're speaking their book. Avoid the stock. It's probably going lower. Making lower lows on the slow Stokes. If anything, we break down below 56.50, the stock is a short. Let's check out the weekly chart just to see how broken the stock is. And I'm sure that you have institutions that remained long because they weren't watching the charts, and they're going to try to spike this puppy higher after this beautiful, beautiful run-up. I wouldn't short it here just yet, but you get a new weekly low, it's a short all the way down to $50 per share. And here's another instance where the market sent you a signal. Again, this is a weekly chart. We peaked out on RSI back in January of 2014. Think about that. January of 2014, we peaked out. We pulled back, and then we went on to make new highs. What was the RSI doing the entire time? Making lower highs. Now, if a member had asked me about this chart ahead of earnings, this is the value that you would have gotten from a membership with the Contrarian Trader. I would have told you, get out of this stock. There's no reason to be involved with this ahead of earnings. Why bother? It's a gamble. The markets are sending you a signal that all is not well. You have divergences going on here. The daily chart, going back to it, had a breakdown, a head and shoulders breakdown. Why be involved with it ahead of earnings? Get out. Tesla. I've been bearish on Tesla for quite some time now. We shorted it a while ago. I think it was back here, and we made a decent profit. It subsequently rallied. Again, though, look, the RSI in a downtrend, diverging from the price action, and even here, it got even worse. Making higher highs, head and shoulders set up, left shoulder, head, right shoulder. Here's your neckline. There's no reason to be involved with the stock. Oil is going down. It's going to continue to go down. To think that Tesla, with the price point of their cars, is not going to take a hit from declining oil prices, that's craziness. I think Elon Musk is a genius. He's going to be the new Bill Gates, the new Steve Jobs. I think there's going to be a place in the history books for him. But right now, I think that his stock is broken, and there's no reason to buy it right now. And this is a weekly chart. Let's take a look at a daily chart. Maybe it's telling a different story. No way. The downtrend is in effect. Lower highs, lower lows. The trend continues. Big breakdown today. Down 3.21%. You have to avoid this stock. Now, if it pulls down to 185, holds that support level, the story may change. We'd have to revisit it. But until then, I wouldn't touch the stock. I think it's broken. Exo Resources. You have to avoid it. In a long-term downtrend, I don't need to look at the weekly chart. The daily chart is sufficient. Lower highs, lower lows. They're trying to hold 1.68. They rallied above this breakout point here on the 26th. What did it do? Breakout point failure. Again, another breakout point failure. What does that mean? We're coming down here. We're going to retest the support level. What in all probability are we going to do? We're probably going to break the support level. I would avoid it like the plague. And it is quite possibly a short. And that's it, folks. Members, stay tuned for the market wrap. I'm going to go over the day's events on the markets. I'm going to go over our watch list. I'm going to go over our positions and how we plan on trading this market. We had a great day today. Let's keep the momentum going, and I'll catch you there. And folks, in closing, please be careful. This market, in all probability, is going down, and it's going down hard. I beg of you, if you're not using a stop-loss order, sit back, take the evening to think about where a logical stop-loss order should be put in, and preserve your capital. Keep that dry gunpowder on the sidelines, because at some point in time in the future, there are going to be great bargains out there, and you want to be liquid. And right now, we're looking for short opportunities. Everybody have a profitable trading day tomorrow. Be well.